Hey, everybody. We're going to do something a little bit different this week. I want to talk about oil production. I want to talk about efficiency gains and that sort of thing. And then I want to get to some of the questions you guys have been asking in the comment section. There's been some really good questions out there, and I think it dovetails nicely with what I want to talk about this week. Hey, I'm Aaron with the Oil Balance, with over 30 years of experience in oil trading and analytics, and I want to elevate your understanding of the oil market. So let's get into it here. Okay, like I said, we're going to do a little bit of a different format this week. I don't have any charts or graphs, but I want to tell you about something I did. So in my career, I worked for 10 years on Wall Street. I've worked for a refiner, I've worked for a major distributor, I've worked for a major trading shop. Most recently, I worked for a big bank that was really heavily invested in oil trading, sitting right on the trading desk there. Uh, but I've never been on the producer side. Of course, I've had a lot of talks. I have friends in that side of the industry, professional conversations, especially from the banking side with oil producers. But I've never actually worked for an oil producer. So Weatherford was kind enough to extend to me an invitation to go to their Forward conference just last week actually, and I wanted to share with you some of the things that I saw there. Some of the things I thought were super interesting. And again, it sort of dovetails into the questions you've been asking here recently. So let's get into this slide deck I made up for this week. So to sort of, I guess, start at the end and work our way backwards. We'll do this in a little bit different order, but one of the breakout sessions that they offered was the field of the future, right? So what would happen is there was 2 day conference. Each morning we'd have a keynote speaker and then sort of panels. So the entire group of attendees would sit and listen to this, and then there'd be breakout sessions. And I think they had 4 different choices for each breakout session. They had 4 or 5 breakout sessions per day in the afternoon, so you could kind of pick and choose what you wanted to go to. Of course, me maybe not understanding exactly what they were talking about, since this is not my area of expertise within the oil industry. I was looking for keywords like efficiencies, or how you're going to gain this or how you're going to achieve that. So those are the sort of classes I picked for the breakout sessions to go to, and one of them was called the field of the future. So let's start there, and let me tell you what Weatherford is thinking, where they're coming from, and where sort of their conception of what the ultimate field would look like in the future. So ultimately, what they would want you to do if you're a producer is come to them when you acquire the land and you've got seismic and that sort of thing, and go to them and work out a plan together about how we're going to reach the reservoir and how we're going to manage all this. So start at the before anything's actually been done, to go with them and figure out a game plan. And of course, from Weatherford's perspective, I think that probably makes a lot of sense. But to figure out sort of a comprehensive game plan about what you want to try to do. There's a lot of talk through the session, and I have a slide on it later about managed pressure versus drilling versus just wells, like through the whole life of the well, which we'll get into in a minute here. And there's just an absolute ton of information that they're able to recover. It's mind blowing how much information they're recovering. And so one of the things they were talking about is developing digital twins. And it sounds like it's not maybe a new concept, and maybe some of the bigger producers, maybe some of the majors are already doing this sort of thing, but they're offering that platform to where, anybody, maybe even a smaller producer, assuming that they can make the budget work, will be able to have this sort of technology where you get so much information back, you can literally build a digital twin of of the field that you're trying to develop, of the reservoir underground, all this sort of thing, and figure out exactly the best way of going about extracting all the oil and gas you can from that geology that you have to work with. So that to me was super interesting, and then that fits hand in hand with optimizing the reservoir. How are we going to work together to through the various stages of the well's life to make sure that we're hitting on all cylinders, as it were, for the production wells that are already in service that need artificial lift or pumps. They were talking about regenerative circuit. So basically, it's a bunch of capacitors that, as it goes through its cycle, you're drawing on power and then you're putting power back into the capacitors and then drawing on that power to the extent that it sounds like from what they were saying, it's so efficient. You can be sort of out in the middle of nowhere. You don't need power lines coming in to the well site, to the drill site, to keep these pumps running, right? They can just be out. And I think there are some solar uh, alternatives that you can use, or maybe add-ons that you could use to that as well. But the product they offer is just a regenerative. Again, you're using capacitance to store that energy as you're going through the cycle of the actual pumping cycle, uh, to recharge those capacitors, and it just kind of keeps on going on minimum power. It sounds like you would probably need some sort of generator to get things going out there, but you don't necessarily need to be tied in to existing power lines like you would at sort of a normal residential house or something, for instance, to try to bring it back to normal people, if you will. They're talking about rigless interventions, especially on maturing wells. So again, they have a plan in place to deal with different things that come up over the life of the well. There's a ton of sensors and stuff that they can put down hole to get information back, so that they can sort of get in front of, or use machine learning, which they talked about a lot, to sort of sense when problems would be coming up in the near future. And if you can intervene on those issues before they become a huge problem, the whole operation is going to be much more efficient. And they were saying in some cases they can intervene in typical things that happen as well as age without getting a rig back out there, which is huge, right? Just the savings from that alone, and keeping things operating smoothly is huge. And then of course they want your P&A services. So at the end of the life of the well, how are we going to cap it? How are we going to make sure that nothing's getting out, that it's not a danger to the environment, all that sort of thing. So there's some very cool tech that I'll talk about a little bit later that they use through that they actually showed us in the demonstrations, that I thought was super cool. So one thing, so that's kind of what they envision for the future, just an absolute ton of information that needs to be processed, but using all that information to come up with the best way to operate in the most efficient way. And there's a lot of opportunity for automation within that. So one thing they talked about pretty much, especially in the keynote speeches and then in the breakout sessions to an extent, but not as much, is the reduction of workers in the red zone. So on the drilling rig, the guys that are actually operating the machinery in the high danger areas, right in the red zone, they want to try to minimize that. There were some times that they talked about sort of eliminating that and trying to go to like a pure automated thing. I don't know. We'll see what the market thinks about that, but just I want you to keep in mind that from Weatherford's perspective, it's going to take fewer and fewer actual people out in the field to make these things work, because they're getting all this information, because they built the automation features into it and that sort of thing. So I found that super interesting. Of course, they're going to reduce your rig time, which is one of the big costs in drilling a well. Tons of data, like I mentioned, and they've come up with a unified data model, or it should probably be a unified data platform. So they're able to take data from other vendors and put it all into one nice place, where the engineer that needs that sort of data can just log into one program and get all this information from all these different sources into one place and do his job efficiently and quickly, and hopefully make the right decisions because he's got all this data for himself to look at, or herself, I guess. And then, as I mentioned, the Weatherford automated surveillance platform system with automated interventions. One of the things they showed us, and I don't think this is particularly new or groundbreaking, but I thought it was fairly, made a big impression. Right, is they had a view from a surveillance camera that was out that was looking at the actual deck, the working deck of a drilling rig. And as various people would come in and out as they were doing their jobs, the AI or whatever it was would highlight them in a different color, so it was really easy for the human to see, okay, that's a picture of another human in there doing their job, whatever it is. And what she didn't notice is off to one side, it was off to the left, if I remember right, there's a person that came out of the office and they weren't wearing a hard hat. And immediately the AI flagged that and sort of had a little red, basically red arrows pointing at the guy's head, going, "This isn't right. He should be wearing a hard hat." So, I mean, yeah, okay, maybe it sounds a little bit like a big brother nanny state sort of thing going on. But if you sort of step back and think about other maybe scenarios that were going on, where that might actually be a huge benefit from the point of view of the producer, if they can catch things early enough and mitigate them, not just people being in the red zone, but just the operation of the well and general pressures underneath the ground. If they can catch these things before they become a problem, before they blow up, so to speak, obviously you're going to have a much better time and maintain production and this sort of thing. So that was super interesting. But I wanted to get into a couple things here. One of them is just the amount of data that they were pushing. One thing I wrote down in my notes, and again, if somebody in the comments wants to sort of double check this, and I'll of course run it past Weatherford themselves. But I wrote in my notes 20 terabytes of data per well per day. I took a lot of notes, guys, because like I said, a lot of this information is sort of new to me. I'm not used to that part of the market, so I was taking a ton of notes on these things. Anyway, one thing they were talking about is 4D seismic, along with other like temperature and pressure readings that would come very quickly, right? So it's not just once an hour or anything like that. It's much faster than that. They showed us these 4D seismic pictures, which obviously as it's moving through wherever the camera is moving through the well bore, uh, I believe they said 40 feet, maybe it's 20 feet above and 20 feet below, and that's your 40 feet. But it gave you like a huge a view of what the rock is sort of around you that you're going through at that time. And they talked about different scenarios. I'll bring that up here at the end when talk about the P&A section. But one really cool thing they did show us is the seismic. I call it a camera. I'm not sure what you call it. Microphone. The seismic going past the point in the well where the concrete began, because that's where you want to put a cap to cap it off later at the end of life for the well. And you could clearly see through the way they had the data presented where that concrete was. There were several different ways you could read how well it was adhering or not to the steel pipe case. Uh, were there problems? Were there big cracks in it? Were there pieces missing? You could see all that in this data. And so from that perspective, yeah, I can understand 20 terabytes of data per well per day. But that's just a ton of information. Like how is anyone going to process that much information? Well, they came up with this R2T2 device, which basically is the size of maybe a large paperback book, not a full hardback, but not those pocket paperbacks, something in the middle. But the point is not big, something you could actually carry around with you if you wanted to. But it would be installed right there at the in the field, right at the wellhead, and that's where all the data is being collected. And they've got these AI models built into it and machine learning models built into it already. That's already starting to compute that data, to crunch that data. It's connected to the rest of the world, or however you need to get it, via the cloud, via Wi-Fi, via 5G, whatever the situation is in that part of the world, however you would stream data. But I thought the interesting thing was the way that they talked about it being set up is, yes, you'd collect all this data and be able to retrieve it later, but the engineer would set up a set of parameters, I would imagine, around pressure and temperature and that sort of thing. And if the data started deviating outside of those parameters, it would immediately set off alerts and let the human know that, hey, there's an issue here you need to be looking at. Probably faster than it sounds like it would, you'd be informed much faster than just having an analog dial out there and having to have someone walk by and actually look at it, right? So that seems super interesting to me. They also have different ways of gathering and handling this much data, which I'll get into here in a minute. But they actually showed that device. The one of the VPs, was showing it around to everybody. So that was very cool. Another interesting thing was a virtual flow meter. So apparently, a flow meter is a pretty expensive bit of kit that you have to have on your well, but these virtual ones are much cheaper. So you'd still need to have real flow meters, but then you could start adding these virtual ones along the line that would basically learn off of what the real flow meter is doing, and the more volume goes past it, the better it learns, right? So that's where the AI comes in to sort of keep it recalibrating, so you get a more precise reading as it the longer it sits there. So that sort of thing I thought was super interesting, and another way to you get more information at less cost. So I think that was that's probably a huge deal. And then the Petrovisor is that unified data platform. I believe Petrovisor is a company that Weatherford purchased a few years ago. I got to talk to one of the engineers, absolutely brilliant guy, very nice guy, about how they're doing that, and it's just it seems like of course that's what you have to do, right? To bring it all into one, bring all that information into one sort of platform where you can look at it and modify it. But it's not just that you can access the information from one place instead of having to go to several different places. Is that the company themselves, the producer, if they have engineers that are already writing models about certain situations and whatever they need to do to get their job done on a specific well, if it's a good model that wants to be shared, this platform lets that engineer share this model across the platform to other engineers in the same company, right? So I think that would be amazing, especially if a creative engineer figures out a workaround on this, or heads up some sort of um, impactful program based on the data they're getting. Previously, it seems like it would sort of just sit with that engineer, and he'd have an easier time of it, but maybe the rest of the company wouldn't benefit. This gives a platform for that engineer to share that work up to the wider platform, up to the company, and maybe an engineer in a different part of the world working for the same company could see that model and be like, "Oh, yes, that's interesting. I can use that," or "I like the way you built this architecture here. I'm going to build something similar off of that." And so information gets shared more efficiently that way. Again, so maybe if somebody figures out something in the Permian that works, and a guy in the Middle East working for the same company tries it and sees a similar efficiency, now maybe you're onto something, right? And you can um, be able to share that across the market. Or sorry, not across the market, but across your company, and just make the whole company more efficient. So I thought that was pretty interesting. They talked about AI quite a bit, to the extent I was kind of looking around going like, is this a tech company or is this a oil field services company? But what they've done, if you can imagine, like the AI that you can find on the internet does not have a lot of information about oil and gas, right? Just because nobody puts that information up there for it to learn from. So Weatherford, however, has they claim 100,000 wells all over the world that they have gathered information from, and that's what their AI model, that's what their foundation model is based on, is all the information from 100,000 wells, from shale to deep water to all sorts of different scenarios in different locations, and that's what the AI is learning on. So it's a proprietary AI model that is based solely on oil and gas information, which is completely different, right, than what you would find on just something generically on the internet. So that seems super fascinating to me too. So just a couple of really quick examples of some of the breakout sessions that I went to that stuck with me. Again, being relatively new to this side of it, maybe I was attracted by the shiny lights that maybe a more seasoned person would not be. But at any rate, the single trip completion system, they're claiming 60% reduction in rig time. So if you recall, having the rig and paying for it on a day by day basis is probably one of the bigger costs that you have in drilling a hole in the ground to try to get oil out of it. So if you can do all you need to do to complete the well um, in a shorter amount of time and do it all in one trip down and back up, then obviously you're going to save money on how much it costs to drill that hole. One thing that was super interesting is they talked a lot about RFID tech that they're using down at the bottom of the hole. So RFID, is pretty ubiquitous. It's probably on your, the bank cards or credit cards in your wallet right now. But sending different sensors down to different depths within the borehole, again, different stages of completion, they can actually have these things do different operations. And there's some that are one-time use and some that are multi-time use. But it sounds like they would just stay down there in the hole for the duration. I might have that part wrong. But anyway, as they're going through doing the completion, they can send a pulse wave through the liquid in the well itself at a very specific frequency and for a very specific time, and that would activate these RFID um, switches basically to go do whatever job that they are programmed above ground to do. So some of them would go, would turn on a valve. Some of them would in, check the screening, right? If you're about to do the fracking stage, that sort of thing. Like it says here, the control device to control gas and water, improve drainage, that sort of thing. Different flapper valves that they have set up with RFID. So that was super interesting to me, right? That just this pulse wave that they can send down there, so okay, guys, time to go, time to do your little job, is just amazing. And to be able to complete in one trip is a pretty big deal. Another thing they talked about that I think made a lot of sense is managed pressure wells. So managed pressure drilling has been around for quite a while, and typically it's when there's some sort of problem, they bring in the pressure management system, and they're able to maybe keep a better control of whatever's going on, or to figure out the problem, or give them an environment where it's easier to solve the problem. What Weatherford is suggesting is that you don't do it just for problems when you're drilling. You would do it on all your wells for the entire lifetime of the well, right? You'd be able to control the pressure on there. And there were some really interesting things that they were saying about that. Is one that preserves the formation, again, because you're not, if you think about maybe like shaking a 2-liter bottle of soda up and then releasing the cap, that would be an unmanaged or mismanaged pressure situation, right? Where it's just causing it to go everywhere. Uh, Obviously, if same thing was shaken up maybe by your toddler or something, you're trying to open it, you do it very slowly and manage that pressure. And so you're trying to keep in that instance, right? You're trying to keep as much of the liquid in the bottle for future consumption. The opposite would be true, obviously, of drilling. But in both cases, you want to manage that liquid in that very quickly changing pressure scenario. So one thing they were saying is like you might get a kick, which is, so imagine you got a sudden pocket of natural gas, or the shale, broke away, the formation changed a little bit. You get this little pocket of natural gas or whatever in your oil stream, and all of a sudden the pressure changes. Well, the data systems that they have in these holes would be able to see that very quickly and be ready for that kick. They call it a kick. Be ready to manage that change in pressure much more quickly. Again, we're talking about automated processes, but being able to manage that much easier than a human could, again, based on the sensors and seeing that pressure change and then doing what it needs to do to manage the pressure on that. So I thought that was super interesting. It also makes it easier to manage problems that come. So the wellbore changes over time. Over, if you're thinking about a 30-year maybe life of the wellbore below surface, things can change, things can shift around. If you're working in a managed pressure environment, you're much better off at one, picking up those changes, and then two, uh, keeping it from getting out of control, or at least being able to see what's going on and start to address it before it gets out of control. So I thought that was really interesting too. They did mention some savings on this, like 17 million saved using pressure during cementing versus unsuccessful conventional cementing attempts previously. 12 million, same sort of thing. They saved 25 days work of remedial work that had been done on a drill immediately, a hole immediately adjacent to the one that they were trying to drill. So things like that, which seems, like those savings could add up. And then over time, again, it's not just the upfront cost of the drilling, it's keeping that product flowing, keeping it coming to the surface. And if you can do that in an efficient manner, that seems to be like a pretty big deal. Okay, so any rate, the amount of data, I can turn this, let me just turn this really quick. Thing I wanted to mention of some takeaways that I had from the event. Again, I thought myself thinking, is this a tech company? What's going on? It seemed just like I've never been to one of those Apple release events, but you see them on TV, and that's what it felt like that's what the vibe was like, if you will, from this sort of thing, especially in the beginning of the keynote speaker sections. One thing that hit me that was pretty interesting, I'll pop my face back in here for a second. One thing that hit me that was really interesting is that in the first panel group of the first day, so you had the keynote address, and then you had a panel, so the whole audience was there for this panel discussion, and you had senior VP from Saudi Aramco, senior VPs from BP and Chevron sitting up on this panel, basically telling people that in the audience that Weatherford has helped us do this, this, and this, and become more efficient, and these things really work, and rah rah rah, we're extracting oil more efficiently, basically, to the audience. Well, who's the audience? It's mostly U.S. companies. I want to say shale. There was some offshore guys there too. So this dichotomy, at least in my head, I had this dichotomy of, the Middle East, Saudis are going to do one thing. They are probably looking at a different set of equations than we are over here. But so we're sort of opposed, right? We're against each other. But that's not at all what happened at this conference. You had a senior VP from Saudi Aramco telling people that, yes, this actually works. This actually benefited our company. We tried this, it didn't work. We tried that, it worked. Weatherford was helping us, blah, blah, blah. So I thought that was super interesting. And that's more of like maybe just in my mind, I need to maybe change that a little bit. But I thought, reflecting afterwards, I thought, hey, that's actually a pretty big deal. And Saudi has a lot of shale, right? So what works in the shale in Saudi Arabia is going to work in the shale in the Permian and other places here in the U.S. as well. So I thought that was pretty interesting. They had a lot of tech company there. So a senior person from Amazon Web Services. They had some other senior tech company people there too, especially talking about cybersecurity with all this information that we're talking about. So I thought that was interesting. Again, that's not what I was expecting. I was expecting to learn about, cutting heads and different sorts of steel they're using downhole and that sort of thing. And again, much of the time was spent on data and not on steel. Okay, so another thing that was really important, I thought, was the NOCs and the super majors, so the national oil companies and the super majors, made comments. And again, this wasn't coming from the Weatherford people. This was coming from the big customers, right? Saying, we don't like the current setup of transactional agreements where, we pay you X amount of money to do this and you do it or not, and there's penalties or, whatever. They wanted to try to get away from that sort of normal paradigm and move into more of a partnership. And I thought that was really interesting for a couple reasons. But the reaction too from the Weatherford people was like, oh yeah, yeah, yeah. They weren't, it seemed like, I don't want to say they were endorsing the idea whole cloth, and I don't know if that's actually an opportunity, if that's something they can actually do. But it's really interesting given, again, my background and the way I'm looking at things, because coming from a banking background, and my wife was in the banking side of energy as well for a long time. is that, let's set aside the NOCs and the super majors for a second, but talk about sort of the middle and smaller US oil producers. They typically have to go to these big banks to get loans or revolvers to sort of keep things going, right? And so you'll get a syndicate of banks coming together where you might have one lead bank and several smaller banks in there, but they're all contributing money to this revolver that if the oil producer needs it for liquidity, it's right there. They can pull it down as they need it. And now it seems like there are some ramifications from the equity side of things, what people will think about if they're pulling these revolvers, but that's maybe a separate issue. The point I'm trying to make is that it was sort of expected that if the banks or the syndicate is lending you this money that you're going to hedge, there's depending on what sort of agreement it was, there's very likely some commentary in that contract about you're going to keep your hedges at least 80% or whatever that number is for that particular agreement. So again, going back to the banking syndicate, the lead bank is, let's say they contribute 50% of the money to that revolver. They're going to expect about 50% of the trades of the hedges because that's where they're going to make their money. That's where all the bank syndicates are going to make their money, is when the producer comes back to them to hedge. That gives the bank something to trade around and something to actually make money on. Whereas they're probably taking really slim margins on the interest rates, right? So they're offering very good interest rates to the producers, and they're planning on making money trading around these hedge programs. So hopefully that makes sense. If you turn that paradigm around and say you get a big company like Weatherford coming in there and partnering, and again, Weatherford was not promoting this; the really big guys were promoting this. But if it were to change to that, that really flips that paradigm on its head. Depending on who the producer is, do you still need the banks to come in and subsidize that? I mean, you might, and that might be a requirement if Weatherford. Again, this is a huge hypothetical. If Weatherford were to come in and partner with a smaller producer, they would probably want some sort of banking arrangement on the back end of that. They would probably also want the producer to hedge, but then who does the hedging, right? How does that partnership work? So it raises a lot of questions, um, not necessarily for the big guys because they don't necessarily need those bank loans, but for the medium and smaller guys, that would be a very interesting paradigm shift that could be transformative to the market. It could be disruptive to a lot of things going on in the market. And maybe I can address that in a future video if you guys have questions about that or want me to keep going on that. But I thought that was absolutely fascinating to think about. And then the last comment I wanted to make here, let me take my face out of this again, is just based on my estimates of what I heard in these talks. I think that you can get to about a 20 to 30% gain in efficiency. Of course, if all of these methodologies were accepted, if they didn't say anything about the cost of these things, but let's just say they're cost effective and you're saving money, it would dramatically, well, maybe not dramatically, but noticeably drop the half cycle costs of actually drilling the oil well in that economic break even number, which is now in the Permian somewhere between 60 and 70, depending on who you are and where you are and how you're connected. Maybe that moves that as much as $5 lower, which would be interesting because I've been talking for a while about that $55 area in crude more from a technical level. We tested that level earlier this year, and just on the wide scale technical picture, it looks like something we need to revisit. It would be super interesting if I'm right in saying $5 drop in costs, and now 65, or sorry, 55 is now sort of the bottom end of the economic break even. And what I'm saying is if the market for some reason needs to tell US shale to stop, it needs to go all the way through 60 and down into 55 to effectively stop production growth, if that makes sense. So that raises some really interesting issues. Um, but one thing it would do, let me put my face back in here. One thing it would do, though, is make obviously these companies more efficient. So what seems like a very scary forecast that you're seeing from the like the STIO models from the International Energy Agency or the U.S. Energy Intelligence is, they're all forecasting super low prices for next year, but maybe with these efficiency gains, that's not quite as scary for the shale patch as it was before. If we got down to $45, like some are calling for, that's still pretty catastrophic. But maybe not quite as bad as what we're thinking now. Which gets me to some of the questions you guys have been asking in the comment section. I've been trying to answer them as they come up in the comment section, but I know the viewers don't necessarily scroll through the comment section to see what's going on, which is fair enough. I don't do that either for other YouTube channels that I watch or consume data from either. So let me address some of these things. So they're good questions, and I wanted to sort of address them in a video like this so people can maybe benefit from the good questions that were being asked. And these aren't really in any order other than the order that I saw them going back through the comment section. So what would a recession do to U.S. shale? Well, it depends on where the recession is made manifest. What we're most worried about is a decrease in gasoline and diesel demand, and to an extent jet fuel demand, because that's what pushes back on the only consumer of crude oil is a refinery. If refinery margins are hampered, they're not going to pull as much crude oil, and that's what pushes prices back then to shale or to the U.S. producer to get them to stop or to slow down. So that's the big tell. What's demand doing? In the last video I did, I can put a link here in this video to last week's video. I spent a lot of time on the monthly demand data, which again I think is I know for absolute certainty the monthly data is more robust. It's more reliable than the weekly data. The problem is the data set that just came out told us what happened in July, whereas the weekly data set tells us what happened as of last Friday. So the good news is the monthly is more robust. The bad news is it's pretty delayed because they go back and research all these things. That being said, the demand was looking really good. Midway through the year, the first half of the year, demand's looking really good. Even gasoline, which is flat year on year, is doing good in the context that it was forecast to be down year on year. So flat would actually be ahead of the curve in terms of what the forecast was saying. Diesel and jet demand are up about 2% year on year, which is pretty good. That's doing pretty decent. Of course, we have to widen that out and say, well, what's demand doing in the rest of the world too? That's why we're watching Asia so closely. Obviously everyone's expecting demand growth from China. That's sort of in the energy industry anyway. That's what we typically tend to think of as the driver of growth. I think sometimes we forget to look at domestic demand, which can actually be quite big as well, since the numbers for demand are actually in the US are actually bigger than what they have in China. So hope that helps. But keep in mind too, what does it do to U.S. shale? At the beginning of this report that I did here today, we were talking about how Weatherford sees it anyway. You need fewer workers on site. You still need very educated engineers that know exactly what they're doing. But they're trying to get away from rig hands in the red zone, right? So maybe that sort of exacerbates the situation in terms of shale if you need fewer workers in that section of the market. And again, those historically are really well-paid workers because it is dangerous work. There is a lot of upside to getting it right, that sort of thing. So I think that's maybe an interesting aspect of it. I think I might have mentioned in years past when the market would contract, you'd get rig hands that would get laid off, right? Because the oil market's contracting. It's pretty cyclical, right? So as the market would retract, these guys would get laid off and they'd go find other jobs, maybe something more stable. And then the next time oil starts to take off and needs to grow, the producers have a hard time rounding up these rig hands again because they're off doing something completely different. So the fact that in that way of looking at it, the fact you need fewer workers might be a little bit better for shale in that you don't need as many people you have to go out and find to come back to make things still work. But Uh, you know, all right. So why is Saudi trying to grow production even if it's just market share? So again, I think that comes back to the perception of where we are in the market. There's a lot of data from the banks, or you can see, on uh, Google searches or whatever from Reuters or Bloomberg. There's a large section of the market that believes that we're overproducing. Um, I think in my videos, I've been trying to tell you that the reduction in production that OPEC Plus said they were taking is probably not nearly as big as what actually happened, which is what Petrologistics is. That's what that data would suggest, um, which again would suggest that demand globally is probably doing better than what most of these guys talking doom and gloom think is doing. Um, because if you look at oil inventories, they are super low. Inventories in the U.S. are at the bottom of the 5-year range, right, on crude oil anyway. So things are fairly tight from that perspective. And I got to get to the Chinese part of it here in a minute, but that's definitely part of this conversation. So what happened if you go back and look, you know, you can go back a longer time. We're just going to go back to sort of 2023 when the Saudis and OPEC thought the market was being oversupplied. They decided to take barrels off the market, right? And so Saudi was usually, if Saudi says they're going to do something, you can believe that that's what they're going to do. Either take barrels off the market or add barrels or whatever they tell the market. They're almost always um, forthright and stick to what that plan is that they made public. Some of these other countries, though, were overproducing, and that's where you get that compensation plan coming from. So it makes sense that as a group, if they're coming together saying, hey guys, between us, there's too much oil on the market, we're going to pull back. We're all going to pull back some to try to rebalance the market. But if one or two countries decide not to pull back or can't pull back production, then uh, they're going to grow market share almost just from the mathematical fact of how that works out. So as markets try to recover, and as especially OPEC Plus have been trying to put barrels back on the market, I can see why Saudi is super frustrated, saying, "Hey, we're the ones that tightened up the market by taking so many barrels off the market, and now you guys are jumping in, taking our customers. We're going to try through this compensation plan and through, of course, discussions and that sort of thing, for you guys to bring it back a little bit and let us step in to where we probably should be, because we've been taking more barrels off than our fair share, and you guys have been adding more barrels than your fair share. So let's try to true that up." So that's what's going on in terms of market share. Again, from an inventory perspective, I do believe global demand is doing better than what the doom and gloom crowd say. So there is room for that production to come back on. So let's skip here to China. Is China full? I believe they're around 1.2 billion barrels or so in terms of inventory, which is a lot, right? That's just a lot of oil, and that's just crude oil. They have a capacity probably of around 1.9. There was a story that actually came out this morning talking about another, I think it was 160 million barrels that they want to add in the next however many months, so let's call it between 12 and 16 months. They want to add another 160 million barrels of storage capacity. And they're calling that strategic reserves, which is different than what we think of it here. It's not necessarily, it is government controlled. Everything is government controlled in China. But if the oil companies need to pull on that oil, it's a much easier process to be able to do that than it is in the US, where you literally need an act of Congress to allow barrels to come out of the SPR. So, so yes, China is hoovering up all these surplus barrels. Does that make demand look better than it really is? Yes, it is. It does, which is why we're trying to watch what's happening on refined product prices and balances in the general area. Singapore is probably the closest price hub we have in terms of price discovery and seeing what's going on. The gas oil markets are still really backwardated, which is a healthy sign. That would indicate demand is still going somewhat. Chinese gasoline demand has never been super huge. So in the U.S., think about gasoline demand as being 9 to 10 million barrels per day. In China, 3 to 3.5 million barrels per day. So just in terms of population base per gasoline consumed here versus China, U.S. is absolutely massive on that sort of thing, right? So, um, yes, we probably should be worried on China on the economic front, on the a bit, manufacturing front, creating widgets to send out to the rest of the world. It seems like their LPG demand, and I did a video on this probably a month or so ago. LPG demand that eventually goes into plastic is actually flat year on year, which is better than I thought it would be given the tariff situation in April and May. So, yes, you're right. We need to watch China. Yes, Saudi is trying to claw back market share. And no, I don't think it's going to tip over the market just yet. Demand seems too healthy. So that's the short answer. Is Trump leaning on oil prices for political reasons? Probably. I still have a fundamental question in my head about how effective he is at doing that. I'm sure some of you in the comments section have very strong opinions on that. That he is able to manipulate oil price. I just don't see the direct mechanism, if that makes sense. So yes, he'll make statements that come out, and yes, that would make traders bearish, and there's an indirect connection there. But like I said, in terms of maybe Saudi Arabia or OPEC as a whole ramping up production, I think they're justified in doing so from a global demand scenario, from looking around at global inventories, right? So, and maybe one more thing I should say about China too is I can't recall a time where I saw China exporting oil outside of some emergency sort of situation. So it's a bit of a black hole if China is hoovering up, and they're really good at doing at buying when the market's low because they have so much storage capacity. They can go out and sort of hoover up any surplus oil on the market when prices are really low and just store it and keep it. And of course, there are geopolitical reasons that would be outside of just a price perspective. There are really good geopolitical reasons that they would want to do that, right? If war is coming, if a bigger global war is coming, or supply lines get constrained because of things going on in Ukraine and Russia or Iran and Israel, if supply constraints came into the market, yeah, you'd want to be sitting on a big fat reserve of oil, right? So I think there's a lot of different reasons that it makes sense that China would be trying to buy low and sort of keep barrels on the market. But what they typically do is when prices get high, they stop buying and they just pull down their inventory. Like I said, I don't recall a time where I've seen them actually sell crude oil in the market outside of issues where they had a specific containment problem at a specific location due to a large refinery being down, um, for a longer period of time than they expected or for unexpected reasons. So pretty much once the oil gets to China, it stays in China until it's refined, and then they do have export programs on the refined product side. So can U.S. shale grow? Yes. There's still 20 billion barrels or so of recoverable oil in the Permian. What we're seeing now is just a reaction to price. What's going on with price? Can they grow in a $60 price environment? I don't think people are happy about it. I don't think the producers are getting after it in this environment. Even if they did take all these Weatherford advancements, there's still enough uncertainty. There's still the doom and gloom crowd in the market. It's talking about $45 per barrel next year. I don't think it makes I'm not seeing it from the producers that I'm talking to. I don't think it makes sense from an economic point of view to go out there and try to ramp up production right now. Yes, inventories are low, but as a producer, you probably want to wait till the market sort of dawns on the market. Hey, wait a minute, things are tighter from an inventory perspective than we realized, or whatever the case may be. So yes, there's still growth left in the Permian, at least I would say to 5 more years, to 2030, maybe 10 years. Are there resources that we may, or formations that maybe we underappreciate or don't know about? Probably in that region. So yeah, no, I don't think the Permian's played out. If that's the question, is the paper market weighing on price? Yes, it is. From an inventory, I run several models, like a fair value model based on inventory and demand is the two big components to that. And yes, the market's very undervalued based on those two things. And it sounds like from the comments that OPEC makes that maybe they're doing something similar. So if you go back and look at the press releases with these increases of production that they're announcing, they always make reference to low inventories and healthy market and that sort of thing. So again, if that's what they're doing, I think it makes sense. And yes, the paper market then would be putting its thumbs on the scale, as it were, in terms of the fair value price. And then what about the impacts of debt restructuring and or is it inflationary if oil shoots up again? Yes, it's inflationary if oil shoots back up again. So like you said, it's probably tied to the value of the currency, though. One thing that's really interesting is to keep in mind a weak dollar encourages exports. A stronger dollar keeps barrels here, attracts imports on the, like into pad one on the gasoline and distillate side of things. A debt restructuring, um, yeah, it could. It depends how what all goes into that, right? Um, yes, if there was some way to a method to, or let's say it this way, if you price crude in terms of gold or crude oil in terms of Bitcoin or something like that, it looks super cheap, right? So if there was some method of debt restructuring or changing the value of the dollar, yes, it would probably shoot up, but a lot of things would probably shoot up as well. Um, so yes, that's an interesting question and something we need to keep close tabs on. Uh, and I guess maybe another question is if the world moves away from the U.S. dollar as sort of the reserve currency, which could happen eventually. What does that do to prices? And I guess it depends how that happens. If the reserve currency that comes to the top of the pile at that point in time is based on gold or other precious metals or something a little more tangible than fiat currency, then I would think oil would have to pop up relative to those tangible assets that are backing whatever the new currency is. So yeah, hope that answers that question. Um, and again, you guys are asking really good questions in the comments, and I highly encourage it. If you've made it this far, please consider going on our website and signing up for this Elevate My Understanding report that I send out once a week. So again, that's $100 a month, 4 times a week. It's packed with good information, 20 pages or so of really good information for you to have. This is the same report or similar to the reports that I would write that we'd have on our desks trading at the bank. Because sometimes you just need that little one reference to something, and you don't want to switch all your computer screens away to something else to look it up. It's nice to have those charts and all that information really handy right there. So, at any rate, thank you very much for watching. Let me know if you like this different format. Let me know if you want me to try to get someone from Weatherford on here to talk. I think I'll try to do that anyway, but maybe give me encouragement if that's what you would want to see as well. But so anyway, thank you for watching and have a good day. Bye.